Let's talk about the new proposed Division 296, aka the latest headline grabber in Australian superannuation news. If you've been reading the news, you might think that the government's planning on stealing your superannuation right out from under your nose. But let's actually look at what's happening. Here's some of the headlines. Super balances are under attack. Retirees to be slugged. The $3 million cap that could cost you everything. Whoa. Let's take a deep breath and put down all the fear-mongering and calmly look at what's actually being proposed and how it will affect you. Right off the bat, let's be clear that we don't have legislation yet, but it's certainly anticipated that this will be passed through Parliament sooner rather than later. So all of these comments are based on what was proposed before the election. So what is Division 296? In simple terms, it is a proposed tax law that would introduce an extra 15% on super earnings for individuals with a member balance over $3 million. Remember, this is for individual member balances, not fund balances. That means that if you've got $3 million in your member balance at the end of a financial year, a portion of the earnings above that threshold will be charged an extra 15%. It's not retroactive and it doesn't tax the entire balance itself. It's not coming for your everyday super fund. Let's break it down with a somewhat oversimplified example. Say you have 3.5 million in super at the end of the 25-26 financial year. That's 500,000 over the $3 million cap. Say your fund grows 200,000 in that year. The taxable portion is calculated as the difference between the total super balance of 3.5 million less the threshold amount of 3 million divided by the total super balance of 3.5 million would give you a taxable proportion of 14.28%. Only that proportion of the $200,000 earnings gets the extra 15% tax. If we continue with the calculation, we then times the $200,000 growth by 14.28%, giving us 28,571. That's the taxable growth. 15% on the taxable growth is the $4,287 in additional tax that would be charged. In other words, your fund is still earning you money, you're just giving up a bit more tax on the earnings above the threshold. No one's taking your whole retirement savings and running off with it. One of the most contentious issues about this proposal is the taxing of unrealised gains in super funds. The super fund earnings would include the increase in value of assets held by the fund, even if the asset wasn't sold. This has the potential to disproportionately impact members of self-managed super funds that hold real property. There is also the likelihood that the gains on the property will actually be double taxed to the extent that when the gain is realised on sale of the asset, they'll be taxed again as part of the income of the fund. It's important to keep it in perspective. If this applies to you, there's still opportunity to consider whether it's best to keep your assets in that superannuation environment or whether it would be more tax efficient to actually take them out of super. There may actually be other strategies that could be applied, including rebalancing accounts with a spouse. So remember, we still don't have legislation. So it's not time to make knee-jerk reactions or responses to the tabloid news. It is coming without a doubt, but it isn't a superannuation apocalypse. It's not going to grab your entire retirement, and for by far the majority of Australians, it is not going to apply. But if you are close to the gap, or you just want to understand how Division 296 is going to play into your long-term investment strategy, then take a deep breath, give us a call, and together with your financial advisor, we can put a plan in place to make sure your assets are secured for your future.